This may be the last easy window to build real wealth before the rules of the game become much harder for ordinary people. I do not say that for drama. I say it because I have spent enough time watching markets, businesses, and human behavior to know what happens when the world starts changing faster than the average person is willing to prepare. Right now, the market is sending one message. Reality is sending another, and the spread between those two messages is where the opportunities sit. The S&P 500 and NASDAQ have nearly erased the recent damage. Bitcoin has ripped higher again. Every dip is getting bought with the kind of aggression that tells you one thing very clearly. Big money is no longer waiting for perfect clarity. It is positioning, and that is the whole lesson. The market is not saying all the risks are gone. The market is saying the future still looks valuable enough that people are willing to buy through the risks. That is very different. Most people hear a rally and assume the world must be healing. Sometimes the world is still unstable and price goes up anyway because investors are buying 12 months from now, not this morning, as anxiety. That is what I believe is happening here. The ceasefire extension between the United States and Iran gave markets exactly what markets love most in a fragile moment. Not peace, a pause, a reduction in immediate worst-case fear. That is enough. Strong corporate earnings gave the rally another leg. AI momentum gave it another. And suddenly, a market that felt like it wanted to fall apart instead found reasons to sprint higher while ordinary people were still waiting for confirmation. This is how the game works. The market almost never waits for emotional comfort. It moves when probabilities shift. And if you keep demanding certainty before you act, you will spend your life buying late and selling scared. That is the first thing I need you to understand. Now let me be clear about something else. This is not an everything is fixed rally. That is exactly where people get sloppy. Oil is still too high. The Middle East is still unstable. Inflation is still vulnerable to another push. Higher if energy stays elevated. The Federal Reserve is still not in an easy position. This is not a clean macro backdrop. This is a market willing to look through a dirty macro backdrop because it still believes the larger machine of earnings, technology, and liquidity will carry prices higher over time. Again, that is not safety. That is positioning. And if you know the difference, you stop asking the wrong question. The wrong question is the world perfectly safe now? It never is. The better question is, what is capital doing despite the risk? That is where the answer lives. And what capital is doing right now is quietly telling you that the high time frame path still points higher. That matters more than almost anything else. Because if the larger direction remains intact, then your job is not to outguess every short-term wobble. Your job is to make sure you are on the right side of the larger move. That is how wealth is built. Not by reacting to every tremor, by owning the right things through the tremors. Now let us talk about the deeper reason I take this so seriously. We are not merely in a market cycle. We are living through a technological power shift. AI is not a cute trend. It is not another app. It is not just a better chatbot. It is a productivity revolution, a labor disruption, a capital concentration machine, and one of the clearest ownership opportunities of our lifetime. And when I hear the people closest to the machine, the real builders, the people creating the infrastructure, the models, the chips, the platforms, start openly discussing some version of a future where large parts of society may need basic income or basic wealth because machines will do more of the work. I do not hear politics first. I hear signal. What they are really saying is very simple. They believe the ownership of these systems is going to matter much more than labor alone. That is the point. And if that is true, then there are only two basic ways this plays out for ordinary people. One group prepares, they buy assets, they build ownership, they accumulate exposure to the systems that will compound in this new era. The other group waits, they consume, they scroll, they talk, they react, and eventually they hope somebody else's machine leaves them enough to live on. That is the real wealth divide coming, not old rich versus poor, owners versus non-owners. That is why I say this may be your last easy chance, because right now the door is still open. The world has not fully repriced the scale of what is coming. Yes, some names have run. Yes, some narratives are crowded. But at the broadest level, most people are still asleep. They still think they have endless time. They still think they can prepare later. They still believe another clean crash will come and let them in at the exact perfect price, and that somehow they will have the courage to buy heavily when that day arrives. That is fantasy. The perfect setup is a story people tell themselves so they can delay action and call it discipline. Real discipline is much uglier. It is buying while things still feel unresolved. It is averaging in while your emotions would prefer to wait. It is keeping capital in motion while the crowd keeps looking for a cleaner invitation. That is the difference. Now, I am not telling you to become reckless. I am not telling you to throw your entire balance sheet into one trade and call it conviction. That is not conviction. That is ego wearing a growth stock costume. The intelligent move is simpler. Build a core position in broad quality assets. Keep dry powder in case the market gives you another meaningful pullback, and then build a smaller, higher beta sleeve around the areas where you have the strongest conviction and the greatest asymmetry. That is the playbook, not perfection structure. This is why I believe systematic dollar cost averaging remains one of the most powerful behaviors in the world. Not because it feels exciting, because it works. If the market spends most of its time in bull conditions over long stretches, and if the economy's strongest productive assets keep compounding, then the person who keeps showing up with fresh capital usually wins over the person who waits for the all clear. That is the math. And if you are in the wealth accumulation phase of life, you do not need to predict the exact bottom. You need to make sure you are not standing on the sidelines while the long-term machine keeps moving. That is why I say always be buying, not blindly, systematically. And when we do get the bigger dips, the ugly weeks, the moments where fear comes back and oil spikes and the internet decides the world is ending again, then you do the second part. Buy more aggressively, buy the dip. That is what separates an accumulator from a spectator. Now let me bring the current setup into sharper focus. There are really only a handful of variables that matter enough to move the next leg. The first is Iran, not because you need to become an expert in military strategy, because Iran and the Strait of Hormuz sit close to the heart of global energy transmission. If the situation cools and shipping fears ease, markets can continue breathing. If it heats up and oil spikes harder, inflation pressure comes back immediately and risk assets can stumble again. The second is oil itself. Oil is the fastest translation layer between war and the price of ordinary life. Higher oil means higher freight, higher shipping, higher production costs, higher pressure on consumer spending, and a harder path for the Fed to pivot. If you want to understand why markets can look strong yet still remain vulnerable, look at oil. The third is inflation and the Fed. If inflation cools, the market starts pricing easier policy sooner. If inflation does not cool, the market can still rally on earnings and AI, but the runway becomes bumpier. The fourth is earnings. This is the big one people always underestimate. As long as large companies keep generating real profits, defending margins, and proving that all this AI spend is not merely vapor, markets will keep finding reasons to rise. The fifth is AI optimism itself. As long as capital believes the AI build-out is real, the productivity gains are coming, and the CapEx cycle is still in its early innings, there will continue to be a premium on the assets and platforms closest to that future. That is the framework, not random headlines, needle movers. Now let us get practical. If I were building toward generational wealth in this environment, I would start with core exposure to the market itself. I want broad participation in the long-term engine. I want to own the businesses that will keep compounding if America remains the most important innovation machine on earth. That is the base. Then I want direct exposure to scarce and asymmetric assets. Bitcoin remains one of the cleanest of those, not because I think it replaces every financial asset on earth, because it still sits at the intersection of debasement hedge, network belief, institutional adoption, and asymmetric upside. If Bitcoin trades in the zones where fear is elevated and the long-term thesis remains intact, I want to buy it. If it confirms higher and still shows strength, I still want exposure. That is what ownership looks like in a scarce digital asset. If I want a more aggressive wrapper around that same idea, then a company like MicroStrategy becomes relevant, not because it is a comp stock, because it is leveraged exposure to the Bitcoin thesis through an equity vehicle. You do not buy it as though it were a sleepy blue chip. You buy it because you understand that if Bitcoin runs, this thing can move with even more violence. That is useful if you know what you are doing. Dangerous if you do not. Now, beyond Bitcoin, the alt layer is where people get carried away, so let me explain this carefully. The biggest money in these markets does not come from owning 50 random names and hoping one of them accidentally becomes important. It comes from identifying a small number of places where narrative, liquidity, structure, and timing line up before the broader crowd fully notices. That is where asymmetric wealth lives. You want names that sit close to real market plumbing, real product market fit, or real user behavior that can scale hard when conditions improve. That is why something like Hyperliquid catches my eye, not because it has a cool community, because it sits closer to exchange activity, liquidity, and market structure. It is infrastructure-like, and infrastructure-like assets inside emerging systems can become very powerful when the next risk on Wave starts pulling money back in. If I wanted a public market wrapper around that type of exposure, then something like PER becomes more interesting for the same basic reason. Again, not safe, not for the core portfolio, but structurally interesting. And then there is the meme coin sleeve. This is where discipline matters most, because this is where otherwise intelligent people start acting like cartoon characters. I have no problem telling you that in speculative phases, one large meme coin often becomes the consumer-facing expression of appetite. That is just how these markets behave. But if you are going to participate there, then size it like speculation. Treat it like a tiny, highly volatile upside sleeve. Do not build your future on a frog or a penguin and then call it wealth strategy. There is a difference between intelligent speculation and self-harm with a market cap. Know the difference. Now, perhaps the most important thing I can tell you is this. The biggest money does not usually come from overtrading. It comes from waiting with a prepared watch list and then pressing hard when conditions align. Most of the year is chop, most of the year is noise, most of the year is not the kind of market that rewards impulsive aggression. Then there are periods when the water starts moving the right way and almost everything aligned with the right narrative begins to lift. That is when the biggest fortunes are made, not by guessing, by being prepared. That is why this phase matters. You build the list now, you build conviction. Now you build your core positions now, you keep some firepower now. And when the market gives you a cleaner trend or another flush lower into support, you do not waste time asking the internet for permission. You deploy. That is what professionals do. They do not need to be certain, they need to be ready. And that, more than anything else, is what most people are missing. They think wealth is built by one perfect decision. It is not. It is built by repeated useful behavior, by buying quality assets while the crowd is uncertain, by keeping exposure when the future is still misunderstood, by knowing which higher beta names you actually have conviction in instead of chasing whatever is green that afternoon, by staying liquid enough to act and invested enough not to miss the move. That is the game, and if I am right, the next 5 to 10 years are going to reward owners far more than spectators. If I am wrong, the discipline of systematic ownership in productive and scarce assets still gives you a better future than doing nothing. That is why the asymmetry is so attractive. The cost of action is manageable, the cost of paralysis is enormous. And the window is open right now. Whether most people are emotionally ready for it or not,